Well, absolutely, Reema. A steady quarter is on the cards for capital good players as healthy order books begin converting into revenues. To start with, all eyes are on order inflows. Momentum was held up well this quarter, supported by sustained traction in power T&D, renewables, and the buildings and factories segment. After a prolonged lull, the railway sector is finally showing signs of recovery since April. Early days, but the trend is turning positive. The standout performer though, Hitachi Energy, with order inflows expected to surge fourfold. BHEL is likely to post a strong 37% year-on-year increase, while CG Power is set for a solid double-digit gain. On the other hand, we do have Thermax as well as ABB. They may see mid-single-digit growth, and Siemens could be the only name in the red with a slight dip in order inflows, a rare miss in an otherwise upbeat sector showing. Next up, revenues. Capital good companies are set to post an average year-on-year growth of 19%, clear evidence that the order backlog is translating into billing. Hitachi Energy once again tops the list with a 37% surge in revenues thanks to the execution of the Mumbai HVDC project. BHEL and CG Power also stand out with over 20% growth each. Even Cummins, for that matter, is expected to clock 12% growth despite dealing with a high base from last year's pre-buying cycle. ABB and Siemens, after reporting low single-digit revenue growth in the previous quarter, are likely to post revenue growth ranging between 11 to 12%. Thermax is likely to maintain its 12% growth trajectory too. Margins, though, tell a more divided story. Commodity prices, copper, aluminum, zinc, pig iron have dropped, but margin expansion, not for everyone. Expect margin compression at ABB, Siemens, Cummins and CG Power, largely due to high base effects and moderation of pricing power. But three names buck the trend. Hitachi Energy with sharp margin gain of 750 basis points, BHEL with a 600 basis points improvement thanks to improving operating leverage, and Thermax aided by lower losses from bio-CNG and some of the other projects. Profits mirror this margin divide. Hitachi Energy is expected to steal the show with a 13.5 times jump in profits. BHEL is likely to stage a turnaround, swinging from a 211 crore loss last year to 71 crores in profit this time around. Elsewhere, Thermax is set for a 26% plus jump. CG Power may rise 18% and Cummins should post double-digit growth in profitability as well. ABB India is likely to report over 7% growth. Siemens, however, might lag with the slowest net profit growth among some of its peers. As far as valuations are concerned, there's been a reset, a moderation for most players, reflecting the impact of slowing order inflows and weaker infra spend. Hitachi Energy still trades at a premium of 125 times, but the broader peer group, including ABB, Cummins, CG Power, BHEL, as well as Thermax, are more reasonable as compared to earlier levels. In summary, strong order inflows, healthy revenue conversion, and selective margin improvement set the tone for Q1. With valuations not as overstretched as earlier, this quarter will be about operational delivery and who's best positioned to turn the backlog into bottom line strength.